At 2:17 in the morning, while most of the financial world was asleep, a document moved quietly across Washington desks that almost nobody on television talked about the next day. No dramatic press conference, no breaking news banners, just a technical discussion buried inside a policy briefing about supply chains, critical minerals, and something that sounded strangely out of place in a modern economy: price stability for strategic metals. Most people would skip past that sentence without thinking twice, but investors who follow the metals market notice something unusual. Because for decades, governments avoided saying anything that sounded like they cared where the price of silver went. Markets were supposed to decide that. Politicians stayed out of it. Now suddenly the conversation was different. Silver was no longer being described as just a commodity. It was being described as infrastructure. And when something becomes infrastructure, the rules begin to change. To understand why this matters, you have to understand what has quietly happened to silver over the past 20 years. The metal that once lived mostly in coins, jewelry, and photography has slowly become embedded inside the technology that runs modern civilization. Solar panels require it. Electric vehicles rely on it. Data centers use it. Military electronics depend on it. Even the expansion of artificial intelligence hardware increases demand for conductive materials like silver. That transformation happened gradually enough that most people didn't notice, but governments notice things like that, because supply chains are power, and power becomes a national concern. So when analysts inside Washington begin talking about protecting strategic minerals from collapsing prices, experienced investors start paying attention. Because protecting a supply chain almost always means protecting the economics that keep that supply chain alive. Mining is not like manufacturing software. Mines shut down when prices fall below production costs. Workers leave, equipment stops, infrastructure decays, and restarting those mines later is expensive and slow. Countries that have already lost control of certain resources understand that problem very well. The United States has watched entire industries migrate overseas over the last several decades. Rare earth elements moved abroad. Semiconductor manufacturing drifted away before being brought back through emergency policy. Energy independence became a political priority almost overnight when geopolitical tensions reminded leaders how vulnerable supply chains can be. Silver now sits dangerously close to that same conversation. The reason is simple. Demand is rising faster than most forecasts predicted. Solar energy alone consumes enormous quantities of silver every year. Electric vehicle manufacturing adds another layer. Meanwhile, older industrial uses have never disappeared. Electronics still need it. Medical technology still uses it. Defense systems still require it. And while demand keeps expanding, the supply side tells a different story. Major new silver discoveries have become rare. Environmental regulations slow new projects. Production costs climb as energy and labor prices increase. Some of the largest historical mines are aging. This creates a quiet pressure inside the system, a pressure that rarely appears in daily price charts, but becomes obvious when you talk to miners, manufacturers, and commodity traders. They all see the same thing. Silver is becoming harder to replace. Now imagine you're a policymaker looking at that situation. Your country is transitioning toward technologies that require silver. Your defense systems rely on components that require silver. Your energy infrastructure increasingly depends on materials containing silver. And the global supply chain for that metal is tightening. At that point, the conversation stops being about commodities and starts becoming about security. That's when words like stability and support start appearing inside government discussions, not publicly in a headline that says, "We guarantee the price." Governments rarely operate that way. Instead, the language appears in more subtle forms, ensuring production remains viable, supporting domestic supply, reducing dependency on foreign sources, protecting critical materials. Those phrases sound bureaucratic, but investors know what they often mean in practice. When governments decide a resource is essential, they begin shaping the environment around it, sometimes through incentives, sometimes through procurement, sometimes through trade barriers, sometimes through strategic stockpiling, and sometimes through something even more powerful than direct intervention: signaling. Markets move on expectations long before policy becomes obvious. If enough participants begin believing that authorities are unwilling to let a strategic resource collapse in value, behavior starts changing immediately. Producers hold back supply because they expect higher prices later. Industrial buyers secure contracts earlier to avoid shortages. Investors move into the market anticipating structural shifts, and slowly, almost invisibly at first, a floor begins forming under the market. That is why some analysts started connecting the dots when discussions around strategic minerals began, including silver alongside other critical materials. Because historically, once governments begin caring about supply security, the market rarely stays the same. But something else has been happening at the same time, something that makes this moment even more interesting. While policymakers talk about supply chains, the physical silver market has been sending signals of its own, signals that are harder to hide than policy discussions. In certain periods over the past few years, buyers trying to acquire large quantities of real silver have had to pay noticeably higher prices than what the global spot price suggests. That difference between paper price and physical availability has appeared again and again, sometimes briefly, sometimes more dramatically, but each time it reveals the same underlying tension. The system that trades silver on financial exchanges is far larger than the system that actually produces and delivers the metal. As long as confidence holds, that structure works. But when demand surges or supply tightens, cracks can appear quickly, and those cracks are exactly what governments want to avoid if the metal becomes strategically important. Which brings us back to the quiet conversation happening in Washington. Because if officials are beginning to think about protecting the long-term supply of silver, they are also indirectly thinking about what level of price keeps mines operating, keeps investment flowing, and keeps production expanding rather than shrinking. In other words, they begin thinking about floors, not official numbers written into law, but invisible zones where letting the market collapse would create bigger problems than supporting it. And once investors start believing those zones exist, markets begin behaving very differently. What most people still don't realize is that this kind of transition has happened many times before in different commodities. Oil experienced it. Agricultural markets experienced it. Strategic metals during wartime experienced it. In each case, the pattern looked similar. First, the resource seemed ordinary. Then, demand quietly became essential. Then, governments began paying attention. Then, prices started moving in ways that surprised almost everyone watching. The question now is whether silver is approaching that same moment. Because if the metal truly becomes embedded in the infrastructure of the modern economy, the forces shaping its price may no longer be purely financial. They may become political, strategic, and global. And when that happens, the ceiling people once assumed may no longer be the real story. The real story becomes the floor, and that floor might be forming long before the public realizes it. By the time most investors notice a major shift in a market, the move is already well underway. History has shown this again and again. The people closest to supply chains see it first, then industry insiders, then institutional money. And only after that does the wider public begin asking questions. Right now, silver may be moving through that exact sequence. Because while headlines still treat it like a volatile commodity that occasionally spikes and then fades back into the background, something deeper is unfolding beneath the surface. And the clues aren't coming from flashy predictions or internet speculation. They're coming from the slow behavior of governments, industries, and large capital. One of the most overlooked signals in financial markets is when policymakers stop ignoring something. For decades, silver was easy to ignore. Gold carried the prestige of monetary history. Oil dominated geopolitical strategy. Technology stocks captured investor excitement. Silver just sat quietly in the background, but now silver is being pulled into conversations it was never part of before. Energy transition plans mention it. Defense procurement discussions mention it. Semiconductor and electronics manufacturing depends on it. And when multiple sectors begin relying on the same resource at the same time, governments start mapping where that resource comes from. That mapping exercise leads to uncomfortable discoveries. Many of the largest silver-producing regions are outside direct U.S. control. Supply chains stretch across geopolitical boundaries. Production growth is slower than demand growth, and bringing new mines online can take a decade or longer. Those realities force a simple question inside policy circles. What happens if supply falls behind the needs of the modern economy? It's a question that doesn't just concern investors. It concerns infrastructure planners, military analysts, and economic strategists. Because modern economies are built on materials, and materials don't appear instantly when demand spikes. This is why experienced commodity traders watch policy language so closely. When officials begin discussing resilience or security in relation to a resource, they're acknowledging vulnerability. Once vulnerability is acknowledged, action eventually follows. Sometimes that action is subtle. Government contracts guaranteeing long-term purchases, subsidies encouraging domestic mining, research investments into refining and processing, trade restrictions that discourage exporting raw materials. Each of those steps seems small on its own, but together they reshape the economic gravity of a market. And when that gravity shifts, prices eventually follow. The silver market has already experienced flashes of this dynamic in the past. Sudden demand spikes that shocked traders, moments when inventories tightened faster than expected, periods when investor interest surged alongside industrial demand. But the difference today is the scale of global change happening at the same time. Energy systems are transforming, digital infrastructure is expanding, defense technology is advancing rapidly, and nearly every one of those developments uses materials that weren't as critical 20 years ago. Silver happens to sit in the middle of that intersection. It conducts electricity better than almost any other metal. It performs reliably under extreme conditions. It integrates easily into high-tech manufacturing. Those properties are not easily replaced. So as industries expand and governments take notice, something interesting happens in the financial markets. Expectations begin shifting. And expectations are powerful forces. Markets rarely wait for official announcements. They move when enough participants start connecting the same dots. A mining company deciding whether to invest billions into a new project looks at long-term demand, not today's price. A manufacturing company securing supply contracts for the next decade does the same. Large institutional investors managing long-term capital start positioning before the story becomes obvious. Gradually, the narrative changes. What was once seen as a cyclical metal becomes a strategic one, and strategic metals behave differently. They attract policy attention. They attract industrial competition. They attract capital-seeking protection from economic instability. This is where the concept of a floor becomes psychologically important, not because a government prints a number on a document and guarantees it, but because the system around the resource begins resisting collapse. When production costs rise, when demand expands, when governments want supply security, and when investors anticipate those dynamics, prices begin finding support at higher and higher levels. That support doesn't appear overnight. It builds through behavior. Producers refusing to sell cheaply, buyers stepping in earlier, investors accumulating positions during dips. Over time, those behaviors create an environment where sharp drops become shorter and recoveries become stronger. The market starts acting as if something underneath it is pushing upward. For silver, some analysts believe that process may already be underway. They point to rising industrial demand forecasts. They point to tightening inventories in certain periods. They point to increasing interest from funds looking for exposure to hard assets during uncertain monetary conditions. And perhaps most interesting of all, they point to the tone of policy discussions quietly evolving around critical minerals. Because once governments begin thinking in terms of strategic resources, the economics surrounding those resources rarely stay unchanged. That doesn't mean silver suddenly jumps to extreme numbers overnight. Markets rarely move in straight lines, but it does mean the framework investors use to understand the metal may be shifting. Instead of asking how low silver can fall during the next economic slowdown, the more important question might be how high the system eventually needs the price to go in order to secure enough supply. That question has surprised markets before. Oil markets experienced it decades ago when energy security became a geopolitical priority. Agricultural markets experienced it when food security became a national issue in multiple countries. Each time the same pattern appeared. Resources once treated as simple commodities gradually became strategic pillars. And when that transformation completed, prices rarely returned to their old assumptions. Silver may now be standing at the edge of that same transformation, which brings us back to the idea many viewers find difficult to ignore. If governments truly begin defending the long-term supply of strategic metals, then the conversation about silver may not be about temporary spikes or speculative bubbles anymore. It may be about the level required to sustain the future economy itself. And if that shift continues quietly in the background, the day the wider public finally realizes what has been happening could be the same day the market moves faster than anyone expected.